Hello and welcome to this course on working capital management. Let us start with what we are going to learn and then what are the components of working capital management so that we can have a look at it. So in this course, we are going to work on the understanding of working capital and how we manage the different components of this working capital. So what are the main components of working capital? Working capital is basically a required option for day-to-day functioning of the operations. Whether it's a hotel, whether it's a manufacturing industry, service industry, everything need some money to start with. You need initial capital, and that initial capital is used to pay the salaries, used to pay the initial operating expenses, your advanced rentals, your office supplies, even for meals. So you need some money to start off the business. Once you start off the business, you sell the things to your suppliers. Then in that case also, sometimes you get collect cash and sometimes you sell on credit. So the one you sell on credit, but you need to pay the material, you need to pay the salary, and you need to pay the cost of construction, cost of making it. So some more money is invested into the suppliers. So the main working capital components are cash, which is required for day-to-day operations. And then you need inventory, and then you need receivables. Inventory for especially for manufacturing organizations, which needs money to buy the raw material, be in processed goods, put the material that they have produced on the stores, and then wait for it to sell. So there is always an inventory at some ways. Some companies and some organizations are very good at managing the inventory, so they don't carry a lot of inventory. They use specific approaches like just-in-time approach and other things, so that they minimize their investment into the inventory without impacting the guest experiences, without impacting the customer experiences. And then you have receivables, where if you have to sell on the credit, which is happening for many organizations, in real world you have to sell on credit, except when you are selling on the supermarket, which is not normally selling on the credit to the end consumer. So other than that, B2B mostly is working on the some kind of credit terms. Maybe we have to pay some deposit, but the rest of the payment can be in credit. So there are multiple types of credit terms that we're going to be looking at. And then lastly, the component which is helping to finance the working capital is payables. When you don't pay your suppliers immediately, like receivables you are collecting late from your customers, you can also pay later to your suppliers. In that case, you are financing part of your working capital requirements. Now, why is it important for us to manage the working capital, and what is the objective of working capital management? The objective of working capital management is to run the firm with as little money tied into the current account as possible. If you have learned the financial analysis, my other classes, you will see there are asset turnover ratios, you will see there are asset utilization ratios, there are return on assets ratios. Return on asset ratio or asset utilization ratio usually use the productive assets, which are used in producing the goods and services that the company is selling. So those assets identically is does not includes the current assets as well. So more the current assets are, which are actually not producing anything, because cash does not produce anything. Inventory though is a part of the produce, is a part of the system which is getting produced. So inventory is not producing anything by itself. Then you have receivables, they are not giving you any kind of returns, they are just a credits, right? Then minus the payable, so those investment are not generating any return. So your the higher working capital will impact your asset return on assets and return on equity. And in that way it will impact surely the valuation of the companies. So the idea is to minimize the investment. Now each element has to be managed in its way. So inventory has to be managed, which is can be a significant part of our investment. Then receivables need to be managed. Then you have cash, and then you have the payables, which are way of financing the working capital. Now, the objective of managing the working capital is, there are pro and cons of having a higher inventory, higher receivables, and higher cash. There are some pros, there are some cons, there are some benefits, there are some costs. So before we jump into how we manage these things one by one, let us look at briefly what are the benefits and what are the cost of doing this and keeping the higher inventory.